This morning, gold hit 4,634. Silver exploded to $90.45. Platinum surged past 2,393. Every precious metal breaking records simultaneously. But here's what they're not telling you. When the gold to silver ratio drops to 51 to 1, when Mumbai trades at $85 while we're at $90, when base metals like copper double in value overnight, something bigger is happening beneath the surface. The last time we saw this pattern, markets didn't just correct, they collapsed. So the real question isn't whether silver hit $90, it's what comes after the barrier falls, and whether you're positioned for what happens next. Welcome to Currency Archive, where we decode the market signals Wall Street doesn't want you to see. If you've been watching precious metals long enough to remember when silver was $35, when experts said $60 was impossible, then you understand why this channel exists. Do us a favor, hit that subscribe button. Not for us, but because the next 48 hours could define your portfolio for the next decade. And tell us in the comments, where are you watching from today? What's your local dealer saying about these prices? Let's begin. The precious metals market opened this morning with numbers that financial analysts are calling unprecedented. What makes this morning's action particularly significant is the synchronized movement across all precious metals. Palladium reached $217. The gold to silver ratio compressed to 51.28 to 1, down from levels above 80 to 1 just months ago. When every metal in the complex moves in concert like this, it signals something far deeper than routine market fluctuations. This represents a fundamental shift in how institutional money views tangible assets versus paper instruments. The speed of this bull run has caught even seasoned market observers off guard. Less than a year ago, silver was trading in the $35 range. Market commentators were confidently predicting pullbacks. It won't hit $60, they said. Expect a correction back to $35. Those predictions aged poorly. Silver didn't just hit $60, it blew through $65, then $70, and now sits comfortably above $90. Each previous resistance level that was supposed to cap this rally became just another stepping stone. This isn't happening in isolation. The drivers behind this surge are structural, not speculative. Industrial demand for silver continues accelerating as artificial intelligence infrastructure expands globally. AI data centers require massive amounts of silver for electrical components and cooling systems. Simultaneously, supply constraints are tightening. Major mining operations have not been able to scale production quickly enough to meet the sudden spike in industrial consumption. You have surging demand colliding with limited supply, while geopolitical tensions push investors towards safe haven assets. The gold to silver ratio compression tells an important story. At 51 to 1, we're approaching historical norms that haven't been seen in decades. For investors who understand this metric, the implications are clear. Silver is outperforming gold on a relative basis, which typically happens when industrial demand combines with monetary demand. This dual driver dynamic creates explosive upside potential that pure monetary metals like gold cannot match. But here's where the situation becomes more complex. When markets move this aggressively, profit-taking becomes inevitable. We're witnessing price levels that seemed impossible just months ago. Smart money always takes chips off the table during vertical moves like this. The question isn't whether we'll see a pullback. The question is when and how severe. A correction from $90 silver could easily knock $15 to $20 off the price overnight. That kind of volatility can shake out weak hands while creating entry points for strategic buyers. The regional price disparities are worth noting. Hong Kong markets were showing silver at $84.40 this morning, while Mumbai reported $85.73. Meanwhile, U.S. markets pushed above $90. These geographic arbitrage opportunities don't persist in efficient markets. When you see price disconnects this wide, it indicates either supply bottlenecks in specific regions or capital controls preventing normal market equilibration. Either explanation points to deeper systemic stress in the global metals distribution system. Platinum deserves special attention in this environment. Trading at $2,393, platinum has climbed from roughly $900 in mid-2024. That's a 166% gain in less than a year. For investors priced out of gold and silver at current levels, platinum offers exposure to the precious metals complex at a relative discount. Industrial applications in catalytic converters and hydrogen fuel cells provide fundamental support beneath the monetary premium. As automotive manufacturers transition to next-generation emission systems, platinum demand should remain structurally robust. Base metals are following precious metals higher, which confirms this isn't just a flight to safety trade. Copper hit 6.2 per pound. Nickel pushed to 8.05. When industrial metals rally alongside monetary metals, it signals expectations of real economic activity, not just inflation hedging. The Germania copper bars that were trading around $100 less than a year ago are now fetching $200 to $250 on secondary markets. That kind of appreciation in base metals suggests investors are positioning for infrastructure build-outs and electrification projects that will consume massive amounts of raw materials. The critical question facing investors right now is whether to chase these prices higher or wait for a correction that may never come. Bitcoin crossed $95,000 this morning, while precious metals simultaneously surged to record highs. This correlation isn't coincidental. When both digital and physical hard assets rally together, it reveals something crucial about investor psychology. Capital is fleeing traditional paper instruments at an accelerating rate. Stocks, bonds, and fiat currencies are being abandoned in favor of assets with mathematical scarcity or physical limitations. This dual exodus from conventional markets hasn't been witnessed since the 2008 financial crisis. And even then, the movement wasn't this synchronized. The market opened Sunday night with silver at $72.84. By Wednesday morning, we're at $90.17. That's a $17.33 gain in roughly 72 hours. Annualize that rate of appreciation, and you're looking at numbers that defy every historical precedent for precious metals performance. This isn't normal price discovery. This is panic buying disguised as rational investment. When assets move this violently in such compressed timeframes, the underlying cause is usually fear rather than greed. Investors aren't buying because they expect modest returns. They're buying because they fear what happens if they don't. Several analysts are now projecting silver at $125 per ounce by July. Others are calling for $140 by March. These aren't fringe predictions from newsletter writers trying to sell subscriptions. These are estimates coming from commodity trading desks at major financial institutions. The same people who were dismissing $60 silver 6 months ago are now scrambling to revise their models upward. When the institutional consensus shifts this dramatically, it usually means the move has further to run before exhaustion sets in. But let's address the elephant in the trading room. The $500 silver predictions that seemed absurd just months ago don't look quite so crazy anymore. If the current trajectory continues without major intervention, triple-digit silver becomes not just possible, but probable. The mechanics are straightforward. Industrial demand isn't discretionary anymore. Manufacturers can't simply stop buying silver because the price doubled. They need it for production. Meanwhile, investment demand accelerates as price momentum attracts new buyers. This feedback loop has no natural ceiling until something breaks the cycle. What could break this cycle? Several scenarios present themselves. Central banks could coordinate interest rate increases to strengthen currencies and reduce inflation expectations. Governments could release strategic metal reserves to flood supply into the market. Major mining operations could somehow accelerate production, though this seems physically impossible, given the lead times required to bring new capacity online. Or we could see forced liquidation from leveraged investors who can't meet margin calls as volatility spikes. Any of these events would trigger sharp corrections, potentially knocking prices back 20% to 30% in a matter of days. The historical parallel everyone should be studying is 1980, when silver briefly touched $50 before collapsing back to single digits. That wasn't a gradual decline. That was a vertical drop that wiped out fortunes overnight. The Hunt brothers' attempted corner of the silver market created artificial scarcity that evaporated the moment margin requirements changed and forced selling began. Today's rally is different in character, driven by industrial fundamentals rather than speculative manipulation, but the lesson remains relevant. Vertical moves up can reverse just as quickly as they develop. Gold backs present an interesting alternative for investors struggling with gold's $4,634 price point. These 24-karat gold instruments allow fractional ownership at $923 exchange rate, providing entry into the gold market without requiring thousands of dollars for a single ounce. As primary metals become increasingly expensive, secondary instruments like goldbacks will likely see expanded adoption. The same logic applies to silverbacks and other fractional precious metal products entering the market. The copper situation deserves deeper examination. Germania copper bars purchased for under $100 now trade between $200 and $300 on secondary markets. Some 1 kilogram bars are fetching $250, while 5 and 10 ounce bars command $135 to $150. This isn't speculation. These are actual transaction prices from completed sales. Copper stacks acquired just 12 months ago have more than doubled in value. For investors with over 600 ounces in larger bar formats, that represents significant portfolio appreciation from what was considered a fringe investment. Traditional market wisdom says, don't chase copper, don't allocate to base metals, focus exclusively on silver and gold. But traditional market wisdom also said silver would never break $60. At some point, investors need to recognize that old rules don't apply in new paradigms. Market dynamics are revealing stress fractures that most investors aren't recognizing yet. When Mumbai silver trades at $85.73, while New York markets show $98.21, the 448 spread represents more than simple arbitrage opportunity. It signals broken price discovery mechanisms across global markets. In functioning markets with free capital flows, these gaps close within minutes through automated trading systems. When they persist for hours, it indicates either liquidity constraints, preventing arbitrage traders from exploiting the differential, or capital controls, blocking cross-border metal movements. Neither explanation should provide comfort to long-term holders. The profit-taking question looms larger with each passing session. At $90 silver, investors who accumulated positions in the $30 to $40 range are sitting on 125% to 200% gains. That kind of unrealized profit creates powerful incentives to lock in returns before potential reversals. The challenge becomes finding buyers at these elevated price points. Local coin dealers operate with limited capital and can't absorb large liquidations without significant discounts. Online dealers offer better pricing, but may lower their buy premiums during periods of extreme volatility to protect their own margins. Wholesalers represent the most realistic exit strategy for substantial positions. These larger operations have the balance sheet capacity to purchase significant quantities, though their bid-ask spreads widen considerably during volatile periods. Getting price quotes from multiple dealers becomes essential. The difference between the best and worst offers can easily reach 5% to 8% on larger transactions, which translates to thousands of dollars on meaningful positions. Finding reputable wholesalers willing to pay near spot prices in this environment requires advanced relationship building that most retail investors have not established. The psychological barrier at $100 per ounce carries enormous weight. Round numbers create self-fulfilling prophecies in financial markets. Traders set limit orders at these levels. Media coverage intensifies around milestone prices. Retail investors who ignored silver at $70 suddenly become interested at $100 because the number feels significant. If current momentum continues, we could breach $100 within 7 to 10 trading days. Sunday night opened at $72.84. Wednesday morning hit $90.17. That's 17 or 33 in 72 hours. Extend that pace another week, and $100 becomes not just possible, but likely. However, the closer we approach obvious resistance levels, the higher the probability of sharp reversals. Sophisticated traders will position for pullbacks before the crowd recognizes the turn. When silver traded at $65, $70 seemed impossible. When it hit $70, $80 became the new impossible number. Now we're at $90 discussing $100, like it's inevitable. This pattern of continuously moving goalposts upward is classic late-stage bull market psychology. It doesn't mean the rally ends tomorrow, but it does mean risk is accumulating faster than most participants realize. Stabilization scenarios deserve consideration alongside continuation and reversal outcomes. Silver could retreat from $90 to $87 and establish a new trading range. Markets don't move straight up indefinitely. Consolidation periods allow late buyers to enter, while early buyers take partial profits. A stabilization range between $85 and $92 would actually represent healthy price action, building a foundation for potential moves toward $100 rather than setting up for violent corrections. The absence of any consolidation since breaking through 72 makes the current structure more fragile than it appears. Palladium's movement to $1,119 provides context for understanding the broader precious metals complex. Palladium serves primarily industrial applications in automotive catalytic converters, with minimal investment demand compared to gold and silver. When industrial metals rally alongside monetary metals, it confirms we're seeing genuine commodity shortage dynamics rather than pure speculation. Manufacturing plants can't fabricate catalytic converters without palladium regardless of price. They'll pay whatever necessary to maintain production, which puts a floor under prices that doesn't exist for purely speculative assets. Nickel's climb to $8.05 tells a similar story. Electric vehicle battery production consumes massive quantities of nickel, and automakers have few substitution options available at current technology levels. The entire electrification narrative driving global industrial policy depends on securing adequate nickel supplies. Governments won't allow EV production targets to fail because nickel became too expensive. They'll subsidize purchases, release strategic reserves, or implement price controls before accepting production shortfalls. This government backing creates different risk-reward dynamics than exist in free-floating commodity markets. The titanium market remains comparatively subdued, despite elevated interest in alternative metals. Titanium's industrial applications are specialized rather than broad-based, limiting investment appeal even as investors search for overlooked opportunities. The affordability crisis in precious metals is forcing a fundamental shift in how retail investors approach hard asset allocation. When single gold eagles cost $4,630 and silver rounds exceed $90, the barrier to entry becomes insurmountable for average wage earners trying to build positions. This isn't a temporary price spike that will revert to historical norms. This represents a permanent repricing of monetary metals relative to debased fiat currencies. The investors, who could casually accumulate 10-ounce silver bars for $350 just months ago, now face 900 price tags for the same metal. That psychological adjustment takes time, and many will simply exit the market rather than adapt to the new reality. Goldbacks emerge as the practical solution to gold's accessibility problem. At $923 exchange rate for fractional 24-karat gold instruments, these products allow meaningful gold exposure without requiring multi-thousand-dollar commitments. The premiums over spot remain higher than traditional bullion, but the flexibility and divisibility offset the cost differential for smaller investors. As primary metal prices continue advancing, expect secondary instruments like goldbacks and silverbacks to capture increasing market share from traditional round and bar formats. The question every current holder faces is whether to continue accumulating at these levels or pause and wait for corrections. The answer depends entirely on individual circumstances and risk tolerance. Investors with established positions built at lower cost bases can afford to wait. They're already sitting on substantial unrealized gains and don't need to chase prices higher. But newcomers, or those with minimal exposure, face a different calculation. Waiting for pullbacks sounds prudent until you consider that the pullback to 87 still represents buying at prices that seemed impossible 3 months ago. Strategic buyers might consider platinum as the overlooked opportunity in this environment. Trading at $397, platinum has surged from approximately $900 in mid-2024, yet still trades at roughly half the price of gold despite having similar industrial and monetary properties. The automotive industry has transitioned to hydrogen fuel cells, could drive platinum demand significantly higher over the next decade. Meanwhile, platinum's relative scarcity compared to gold provides fundamental support that should prevent dramatic downside, even during broad commodity corrections. The copper phenomenon validates a thesis that traditional precious metals investors initially rejected. Stacks accumulated for $100 per kilogram now command $200 to $300 on secondary markets. 5 and 10-ounce germania bars fetch $135 to $150. These aren't theoretical prices from optimistic sellers. These are completed transaction values from actual buyers willing to pay premiums for quality copper products. The entire base metals complex is participating in this repricing, suggesting the move extends beyond monetary metals into genuine industrial commodity shortages. Market veterans who remember 2011 as silver spiked to 48, followed by years of decline into the teens, understand that what goes up violently can reverse just as aggressively. The current rally shows no signs of exhaustion yet, but exhaustion arrives suddenly rather than gradually. Silver could trade at $95 tomorrow and $78 the day after, without violating any technical patterns. Vertical moves create vertical reversals. The speed of ascent often predicts the speed of descent when sentiment finally turns. Risk management becomes critical at these elevated levels. Investors who have watched positions triple or quadruple in value should consider taking partial profits, even if they believe higher prices lie ahead. Selling 20% to 30% of holdings locks in gains that can be redeployed if corrections materialize, while maintaining exposure if the rally continues. Nobody ever went bankrupt taking profits, but plenty of investors have watched unrealized gains evaporate by refusing to sell during euphoric market peaks. The coming weeks will determine whether this represents a sustainable revaluation or a speculative blow-off top. Gold at $4,634, silver at $90, platinum at $2,397, and surging base metals all point towards serious monetary system stress. Central banks worldwide are losing control of inflation narratives. Investors are voting with their capital, moving into tangible assets with inherent value, rather than trusting government promises to maintain purchasing power. Whatever happens next, this moment represents a clear inflection point. The precious metals markets of 2026 bear little resemblance to the markets of 2024. Prices that seemed absurd have become reality. Predictions that were dismissed as conspiracy theory now appear conservative. Investors positioned in physical metals are experiencing wealth preservation and appreciation that paper assets simply cannot match. The barrier at $90 is down. What happens now depends on how long confidence in fiat currency systems can be maintained against the evidence of their deterioration.